Download our complimentary guidebooks, checklists, and other useful financial resources at savantwealth.com/guides.
Hello, everyone, and thank you for attending today's webinar. We're going to spend about the next half hour discussing 10 financial strategies that most professionals miss. We also will have an offer for our listeners at the end of the presentation today for a complimentary financial review, so make sure that you listen for that. I thought a little background on our team before we get started would be helpful. At Savant, we are a comprehensive fee-only fiduciary, and we work with clients across the nation at over 43 offices in 19 different states. We have a vast team of professionals that help our advisory team serve our clients in a holistic manner, including advanced tax and legal specialists that allow us to take a truly holistic approach to wealth management. I am joined today by my colleague, John Clarke.
Good afternoon, James.
Good afternoon, John. John and I are both certified financial planners and member owners here at Savant. And John has been advising professionals across the country for the past 7 years. And I have for about 15 years, where our team has completed thousands of financial assessments during that time. And we spend a lot of time with individuals and their families when they're first introduced to our team, understanding their goals and what gaps might exist from a planning perspective. John, do you want to start out by sharing with us what we might cover during the webinar today? Hello, everyone, and thank you for attending today's webinar. We're going to spend about the next half hour discussing 10 financial strategies that most professionals miss. I can see we have quite a few people in the live presentation today, so thank you to everyone who's joining us. I also want to let those joining us know that if you have a question that you'd like to ask, you can submit it anytime during the discussion today by using the Q&A box, and we will respond either at the end of the webinar or we will reach out to you directly. We also will have an offer for our listeners at the end of the presentation today for a complimentary financial review, so make sure that you listen for that. I thought a little background on our team before we get started would be helpful. At Savant, we are a comprehensive fee-only fiduciary that's focused on helping our clients achieve their ideal financial futures. And we work with clients across the nation at over 43 offices in 19 different states. We have a vast team of professionals that help our advisory team serve our clients in a holistic manner, including advanced tax and legal specialists that allow us to take a truly holistic approach to wealth management. I am joined today by my colleague, John Clarke.
Good afternoon, James.
Good afternoon, John. John and I are both certified financial planners and member owners here at Savant. And John has been advising professionals across the country for the past 7 years. And I have for about 15 years, where our team has completed thousands of financial assessments during that time. And we spend a lot of time with individuals and their families when they're first introduced to our team, understanding their goals and what gaps might exist from a planning perspective. John, do you want to start out by sharing with us what we might cover during the webinar today?
Certainly, James, of course. This is something you and I have actually been talking about doing for quite some time. Ultimately, after having the opportunity to work with so many different families and helping them take the first step to build a comprehensive plan, we have both seen a pretty common pattern of certain strategies that most families miss out on when thinking about their finances. So this should be fun for us. We can keep it conversational and try to give you a sense of what most people are not thinking about that they should be. And I believe between the two of us, we came up with 10 opportunities to share with our audience today. The most helpful thing we can do today is share some of the most often missed planning strategies that might reveal opportunities in each of your own financial plans.
John, thanks for walking us through the goal of our conversation today. Why don't we just get started? We can jump into our first topic, which is consolidating your retirement plan accounts. And this actually might be the area where we see the most mistakes happen leading up to retirement. And to be honest, we could do an entire webinar on this topic alone. If you've been employed for any serious length of time, it's not uncommon at all to have several different retirement plans. And it can be very hard to manage all those different plans and accounts that have different rules at different custodians. So the attraction to simplify the account is not only desirable to make your life easier, but it's also practical to help you make better decisions and better manage your investments at the end of the day. The mistake that we see, however, with this is that the plan to consolidate accounts is often dictated by one of the many custodians that you have access to wanting to custody all of your money in one place, or an advisor that's suggesting to consolidate all of your accounts with their preferred custodian. And that's simply, this is one way to simplify things. But you want to make sure that you're doing it for reasons that keep your best interest in mind, because many advisors and custodians will push account consolidation because it allows them to make the most money possible. And you want to be particularly mindful of moving from a low-cost environment within an employer-sponsored retirement plan to a high-cost retail IRA, especially if your advisor is receiving any commissions or 12b1 fees from the funds in those accounts. So there can also be motivation to sell expensive products like annuities that might be not in your best interest or the best fit for your situation. And different custodians have unique strengths and weaknesses, however, so it can often be beneficial to use more than just one single custodian. And if you're still working and making contributions to your plan, it just might not be possible to get down to one single custodian. So when developing a plan to streamline and reduce the number of retirement and investment accounts that you have, work with an independent fee-only advisor that's not restricted to only one specific custodian. The fee-only structure also means that they don't receive commissions from your investment products, so they can objectively help you evaluate how to get the best out of the various accounts and consolidate when it makes the most sense for you. Using software then to view the account for multiple custodians as one unified portfolio is also a great way to increase efficiency and streamline your investment process when using more than one custodian is beneficial or it's your only option. John, before we move on to our next, actually several topics, there's been some major news recently with the passage of what's being called the Big Beautiful Bill. And this bill had several tax law changes. So can you just maybe take a minute and walk us through some of the major components of this bill and how they might tie into some of our next strategies?
Yeah, absolutely, James. And thanks for providing me the opportunity to discuss this next topic. I think we're all still digesting the passage of the Big Beautiful Bill, and there are some highlights that I wanted to share with those in attendance today. But I think, from a planning perspective, we just never want to remain static, and we want to be opportunistic in taking advantage of the planning environment that we're in. So before the Big Beautiful Bill, we had to plan around the Secure Act 2.0, and the Tax Cuts and Jobs Act. So the tax environment we're in it's just constantly evolving. And it's our job to stay on top of those important changes. So looking at what transpired with the Tax Cuts and Jobs Act that preceded the Big Beautiful Bill, you saw a much larger standard deduction, and that will continue. That will increase modestly to $15,750 for single filers and $31,500 for joint filers. And the several current tax brackets that were created were made permanent. So in some ways on that front, it's really just like a continuation of what was crafted in 2017. For a lot of married couples that are filing jointly, this will continue to provide a lot of flexibility to execute tax planning strategies with wider brackets expected in the intermediate term as well. The SALT, or state and local taxes cap, that exists today of $10,000 will actually be quadrupled moving forward to $40,000 for single and joint filers with modified adjusted gross income of $500,000 or less. So if you live in a state with substantial property and income taxes, exceeding that $10,000 limit won't be difficult, and you can see more taxpayers itemizing as a result. And this increase will actually just be temporary through 2029, is at least where it stands today. We're also going to be able to help people receive tax benefits for charitable gifting moving forward based on this legislation. So that was one of the better outcomes from this bill. So even if you're not itemizing now, you can deduct up to $1,000 for single filers or $2,000 for joint filers for charitable contributions. One caveat is those gifts must be cash to receive that deduction. So if you're currently gifting from appreciated stock into like a donor advised fund, you would not be able to receive a deduction in that instance. Finally, we've already seen a very large federal estate tax exemption, and we will continue to be in a very favorable environment in that regard as well. So that current $13.99 million limit, we'll see that increase by about 7% up to $15 million. And then with the opportunity for portability between spouses, and this is set to be indexed by inflation as well. So long story short, very few people in this country will have to worry about federal estate taxes. Income taxes, however, will continue to be the biggest consideration to plan around for many professionals and their families when thinking about asset transfer. So there's just a lot more to talk about relating to the big beautiful bill, and we have a lot of other resources on this topic, but I just wanted to share the highlights and share some planning considerations with the environment we're currently in, and just showcase we have to plan around that environment because it is constantly evolving.
Yeah, thanks for walking us through some of those major highlights of this legislation, John, and also just illustrating how while these changes are impactful, we're likely to see many more changes in the future as the tax landscape is really ever changing. So with that in mind, what is specifically a common tax-related misstep that we see professionals make?
Yeah, and this next topic might be my personal favorite on the list, because I don't know how many times we speak to individuals that qualify to make Roth contributions within their retirement account, and they're high income earners, but they don't think they can make Roth contributions in their retirement account. Has that happened to you 100 times, James?
Probably more like several hundred. Yeah.
Okay. Yeah, so this missed opportunity is extremely common, and understandably so. Many professionals have healthy salaries and assume that the phase-out rules attached to Roth IRAs apply to Roth money that is being contributed into a 401k plan. So if you are single and you have income of over $160,000, or married and bring in over $236,000 jointly, these phase-outs actually do not apply for Roth contributions that are being made within a retirement plan. No income limit or restriction applies in that regard. That being said, it's ultimately a plan rule, but most modern 401k plans do allow Roth contributions within the plan. The contribution limits are going to be based on your age and the IRS limits set, and you can typically make a combination of both pre-tax and Roth contributions in a tax advantaged manner as desired. And those contribution limits are much higher, which I know is something you're going to expound on later in our conversation today, James. The opportunity, I would say, here is really to just build tax balance into the plan, because a lot of professionals have a tremendous amount of income taxes shadowing their nest egg from contributions they have made in their employer plan over time, and that their employers made as well. So to have a portion grow on a tax-free basis over time is going to create greater diversification from a tax perspective, and then more opportunities when building a retirement income and estate plan moving forward. The final thing I guess I'd like to mention when it comes to Roth contributions is that the timing is not always going to be right. With the healthy salaries that a lot of senior professionals enjoy while working, and then some retirement plans not allowing Roth contributions, sometimes waiting until retirement, especially if cash flow needs are reasonable, can create a nice window for Roth conversions in retirement. Each person's financial situation is going to be a little bit different, but this is typically a really good strategy to explore ahead of required minimum distributions. With a Roth conversion, you could utilize a part of your 401k account or outside retirement account like a traditional IRA, pay taxes on converting those assets to Roth so you could receive tax-free growth and withdrawals moving forward. With Roth conversions, you don't have to worry about those contribution limits I was referencing before, so you can be a little bit more aggressive in building that tax balance when considering this strategy.
Thanks, John. You had mentioned contribution limits within the plans, which is actually the next strategy that we're going to cover. And this is very important topic, because knowing the contribution limits for your different plans is usually the single biggest factor to how much you'll have saved for retirement. And it can also be the most impactful thing that you have direct control over each year regarding your personal taxes. And what we found by meeting with hundreds of professionals almost over the years is that in almost all cases, you can be saving more into available retirement plans. So just as a little bit of a review, 401k and 403b contribution limits for 2025 are $23,500. And if you're over age 50, you can save an additional $7,500 on top of that with a catch-up contribution. So that's a total of $31,000. And Secure Act 2.0 also allows for a higher catch-up contribution of $11,250, specifically for participants that are ages 60 to 63. So your total would actually be $34,750 annually. And in addition to 401k plans, some professionals, higher income professionals, have access to a deferred compensation plan, which can allow for up to the same $23,500 contribution amount, and even offer a catch-up contribution on that as well. So participants with some employers could voluntarily defer $62,000 or even more of your taxable income into retirement plans in a year. And if you've done any consulting during the year and were paid as an independent contractor, there are additional options to save some of that income, specifically tax deferred, with plans like a SEP IRA. And that's in addition to the limits that we just discussed through your employer sponsored plan. So if you're a higher income professional and you have self-employment income in addition to your salary, there could be an opportunity in some cases to defer over $100,000 of your taxable income this year into retirement plans.
Thanks a lot, James, for just sharing those strategies on how individuals and their families can save more. The next strategy on our list actually relates to a person's philanthropic endeavors. Oftentimes, when we start looking at a family's entire financial picture and we look at cash flow, if they're making charitable gifts, it's rarely done in a strategic fashion. Most people gift what they can, and they often are just doing it directly from savings or income that they're earning throughout the year. If the gifts are sizable, though, and you're over the age of 70 and a half, and the expectation is that these gifts will continue in perpetuity, having a strategy around gifting can save you a lot of money over the long term.
Yeah, I agree, John. That's where we get excited to go to work for our clients, because there's often a lot of opportunity to add value from a tax perspective. And you mentioned gifting at age 70 and a half. Can you explain to our audience what gifting strategy to consider around that age and maybe even later in life?
Yeah, absolutely. And when we're looking at a family's tax situation, they have a significant amount of pre-tax accounts, typically represented by retirement plans that they've contributed to throughout their career. If you're over the age of 70 and a half, it's common that you've been in the workforce for several decades at this juncture. One opportunity that exists with these pre-tax accounts is you can gift up to $108,000 to a charity of your choice. So if you like to support specific nonprofits, your church, or if you have other philanthropic endeavors, this strategy used to be pegged to required minimum distributions. But as that age has increased to 73 and eventually 75 in the future, this allows you to get a jump start on tax planning today. And eventually you can satisfy a portion or even all of it through what's called a QCD. One stumbling block that people run into due to their asset makeup, and this is a really important caveat to mention, is these types of charitable distributions must come from an IRA account. So mechanically, there's often work on our end to identify the optimal amount to gift from a tax perspective to ensure that we have appropriate assets transferred from employer-sponsored retirement accounts to make sure that actually works in practice.
Yeah, thanks for breaking that down for us, John. If someone is younger, but they're still charitably inclined, and gifting is an important part of their overall plan, what are other strategies that they could consider to help from a tax perspective?
Yeah, thanks for bringing that up, James. Another option to potentially explore would be lumping your charitable gifts or utilizing a donor advised fund. And this type of gifting strategy can be really attractive for individuals where they have, outside brokerage assets with significant appreciated holdings like stocks, mutual funds, or exchange traded funds. And you can make a significant gift within a specific tax year to receive a tax deduction and avoid the embedded capital gains. And that one gift can be used then to support multiple charities over multiple years if you go the route of a donor advised fund. The strategy that makes the most sense for each client is going to be a little bit different, though. QCDs keep adjusted gross income lower, which can help with Medicare premiums as well. So there's really a lot to consider for each family situation, depending on their charitable aspirations, their asset makeup, and their age.
Yeah, it's certainly not a one size fits all approach when it comes to addressing tax planning for charitable gifts, but the magnitude of having a plan in place is pretty undeniable when we see the amount of tax reduction that's provided by structuring that appropriately. Another commonly overlooked strategy among professionals that we're going to cover next is not managing your investment accounts under a unified portfolio approach to reduce unintended risk. And once you have an appropriate asset allocation model established, you can enhance efficiency by treating all of your accounts, such as multiple 401k plans, IRAs, and brokerage accounts, as parts of a single coordinated investment plan rather than separate standalone portfolios. And while consolidating accounts at one custodian may simplify management, it's not always feasible or beneficial. Employer plans often come with restrictions, and if you're still working, there's going to be ongoing contributions. So different accounts have unique rules, like RMD requirements on IRAs at age 73, even if you're still working, state tax exemptions on distributions from some accounts, or special benefits such as fixed rate on deferred annuities within a plan. So instead of defaulting to consolidation, it's often more beneficial to understand each account's nuances and then manage them collectively toward a unified goal. And this unified approach helps you leverage the strengths of the different custodians and optimize tax efficiencies. And then with your allocation and unified portfolio strategy in place, the final step then is to keep your risk in check through ongoing rebalancing. And that's something that's pretty simple in theory, but it's one of the most frequently neglected practices among people managing their own retirement plans.
Yeah, that's a good point, James. And can you just share briefly how rebalancing your portfolio can be effective and how it's not what people consider market timing?
Yeah, thanks for asking, John. So it's true that trying to time the market is almost always going to end up hurting your returns in the long run. But rebalancing is not market timing. Rebalancing is a reaction to what's already happened. So we let the market do what it's going to do, and then we readjust to keep your risk level the same going forward. So let's say, for example, you started the year with a 50-50 asset allocation model, so 50% in stocks, 50% in fixed income. And during that year, stocks do extremely well, while bonds were relatively flat in performance. And if we fast forward to the end of the year, you might now have a 60-40 allocation instead of the 50-50 targeted model that we started with. So if we fast forward from there again to the following year, let's say that stocks that following year don't do as well and they end up going down by 10%, while bonds that following year do a little bit better and they're up by 5%. If you did not rebalance at the end of the first year, your portfolio performed significantly worse that second year. 60% of your portfolio would have gone down by 10% instead of only 50% of it. And only 40% of your portfolio went up by 5%. So rebalancing your portfolio is a very important way to control risk over time. And it's done by systematically selling when the market's high to lock in gains and reduce risk, and then buying when the market's low to increase returns over time.
Thanks, James, for covering that in good detail. Our next topic is estate planning, which is something we haven't talked much about yet. We have full webinars on this, but today we'll focus on some practical steps that often just require coordination. We have a team of estate planning attorneys to help clients. Knowing when and how to start can be sometimes really confusing.
Yeah, it's a complex area, but I think we can offer some quick opportunities to address what we see, especially in the initial financial analysis projects that we do.
Definitely. So one key step, especially for those with significant retirement assets, is it's a straightforward, simple step, but it's just reviewing your beneficiary designation. So even if estate documents like a will or a trust are in place, they don't override what's listed on beneficiary forms. That means that outdated or missing designations could cause assets to go through probate unnecessarily. Given how much of many professionals' net worth are tied into retirement plans accumulated over their careers, reviewing both primary and contingent beneficiaries is essential.
Yeah, that's a very simple and actionable place to begin, John. But what else should individuals look at if they've already created some documents?
Yeah, so another issue is just going to be time. So stale documents. So many people draft estate plans when they're first married or they have children and they never revisit them. So it's not uncommon to find aging parents or siblings still listed as trustees, executors, or powers of attorney. So these roles often need to be adjusted to ensure that the right helpers are in place to execute your plan.
That's a great point, John. When you step back and think about how much changes in 20 years. There's a new Superman movie out this year, but actually they've tried to to reboot it twice already in the last 20 years in 2006 and 2013. So we'll see if it works this time. But
Yeah, exactly. I mean, it looks like it's doing pretty well in the box office right now. So a good rule of thumb would be to review documents every 5 years or after major life events. And even when people do create great estate plans, they sometimes stop short, like setting up a trust, but then they never fund it. That final 10% of coordination is often what makes the plan actually work in real life.
yeah, what final suggestions around estate planning might you have?
I guess, and I touched on philanthropic goals earlier, but if you are charitably inclined, coordinate your charitable gifting there too. As we discussed earlier, pre-tax retirement accounts can be a very tax efficient way to leave to charities, but only if you plan and structure properly. So your family has to have some sort of structure in place for estate planning, just in total.
Thanks, John. So estate planning can definitely feel overwhelming, but just starting with a review of what you have and ensuring that your assets align with your intentions is a pretty powerful first step. So we are now at our second to last strategy, which is not claiming Social Security benefits at the right time. And this topic is becoming more relevant as professionals are working later in life, oftentimes even working past the age when your Social Security benefits maxed out. So the quick reminder, most people can start claiming Social Security as early as age 62, as long as you have enough credits. But if you claim benefits from age 62 until you reach what's called your full retirement age, which can run anywhere from 66 to 67, and you still have work income, you will receive a reduction in benefits, often reducing it to zero if you're working full time. And then after full retirement age, there is no penalty at all for working full time and also receiving your Social Security benefits. But you do receive an 8% increase in your benefits each year that you delay claiming until age 70 when it finally maxes out. Also, if you're married, you can be eligible for a spousal benefit based on your spouse's earnings record if they've earned significantly more than you during your careers. And up to 85% of your Social Security benefit is counted as income and subject to federal income taxes. And several states also tax Social Security income at a state level. So when you're thinking about claiming strategies, it can get very complicated very quickly. And we really need to understand your entire financial picture, including when you'll likely retire, what your total income from all sources is going to look like. Is your life expectancy affected by medical conditions or longevity? What is your spouse's work history and benefit situation? What tax planning opportunities are we trying to explore, such as a Roth conversion before RMD age, like you mentioned before, John? There are so many moving pieces to this that if you do not consider all the planning areas that will be impacted, you could easily pursue a strategy that results in lower lifetime benefits or negative tax consequences and lost opportunities going forward. So we are now on the home stretch, John. Can you walk us through what the final misstep is that we commonly see?
Yeah, absolutely, James. So this last misstep, I think, dovetails very nicely with our offer that we have for those viewing our webinar today. So maybe it's because many families we work with lead really busy lives, but oftentimes we see professionals just wait too long to put a comprehensive plan in place and miss out on some really large opportunities to enhance their financial future. Ideally, you want to partner with a client when it's appropriate, and that timeline can vary greatly depending on what they have going on in their life. But typically, 5 to 10 years out from retirement is a really nice starting point, especially if you've been putting some of the items on our agenda off, whether it's thinking through the best estate plan for your family, or how to maximize your retirement contributions, or building a portfolio that takes all of the different investment accounts in consideration from a unified perspective, as James had walked through. Building a holistic plan for you and your family is ensuring that we can help you make basically the best choices by understanding your goals and the planning strategies that are most appropriate for you. We really pride ourselves in getting to know our clients before they even engage formally with us to ensure we have a comprehensive view of everything entering into a partnership. So for anyone joining us today, we are going to be offering a complimentary financial analysis to give you a sense of if you're on track to meet your goals in retirement and help you start putting that comprehensive plan in place. So this process is an opportunity to have your specific financial situation reviewed by a certified financial planner. This assessment is comprehensive in nature and often gives an opportunity to assess where you are financially. Will help you review and ensure you're avoiding some of those common, overlooked strategies and missteps that we talked about today. The outputs from this, what this actually looks like in practice, will have detailed retirement income projections, assessing the current state of risk in your portfolio, and then also looking at putting together some of the foundational pieces of an estate plan. So we look for, in concert with all of the items that I've mentioned, we also look for proactive tax planning opportunities for you in this process. This is designed for individuals that are really serious about exploring a financial partnership with a planner. If you have interest in completing this analysis, you can click on the link on the chat and we'll get a conversation started with you. We certainly want to thank everyone for joining us today for our discussion and encourage you to check out all the helpful information on savantwealth.com. Before we go here, we do have time for just a couple of questions before we end today's webinar. And James, I think you were going to get us started here.
Yeah, absolutely. Additionally, if just as a reminder, if we don't get your specific question, please click on the link in the chat, as John mentioned, and we're happy to have an individual conversation. We'll reach out to you, make sure we get that answered. But the first question that we have looks like it's actually relating, John, to the financial analysis that you mentioned. It says the process that we're describing sounds pretty involved. How is it typically organized, and how long does it take to complete? So that's a great question. We have a couple of Savant-specific forms that need to be completed, and then we typically ask for some of the foundational building blocks of your financial situation. So items like investment statements, so we can actually see what the specific holdings are in your accounts. Most recent tax returns, so we can do some detailed tax planning projections and ideas for you. A Social Security statement, as well as some other financial items. It typically takes clients a little bit of time to gather everything. We try to keep it easy for you though. And if we stay organized, we can typically have about 2 meetings once the information is received for the financial analysis. The first will be a draft meeting to collaborate on the draft and the information, make sure that we have a good understanding of your goals and that we have really clear information, everything that we need. We'll probably have some questions for you. And then we'll also set up a final meeting to go over our final recommendations for your specific situation. So this process can vary, but we try to be flexible with your schedule. If we stay on track, we can typically have everything completed within a couple of weeks to a month. I'll take the next one as well. We have another question here because they're asking about something that I touched on earlier. It says you had talked a lot about the consolidation process at the beginning of your presentation. I have like 20 different investment accounts between my wife and I. How do you make sure good choices are being made throughout that process? So that's a really important question because a lot of different variables exist that need to be considered as we tailor your investment plan to what already exists. So one of the first things that we do is we'll have a consolidation of custodians meeting because we want to come up with the most effective investment plan moving forward. And in that meeting, we're going to review what the accounts can do. So what accounts can be consolidated, what tax considerations exist, if there's things like capital gains that are kind of embedded in specific positions you have in your brokerage account. We don't want to create a large tax event during that process, during that consolidation process. And then we're going to look through, things that are specific to your employer plans. Are there unique investments or benefits attached to them? Just to ensure that we're really not giving up any positive things that we can't replicate in other places amongst your current account. So it's a lot to put together, but ultimately we have a roadmap that we use to put together as a guide for us through that consolidation process and communicate proactively with the different custodians to make sure we've got a good game plan in place before beginning that. And our position as an independent fiduciary means that we're putting ourselves in your seat and we're making recommendations and suggestions that we believe are in your best interest at all times. So that's a really important piece of it. We don't have conflicts of interest or biases and trying to steer you in one direction or another. So
it looks like that's all the time that we have left. I certainly appreciate everyone that attended today. We hope you have a terrific rest of your day, and James and I thank you so much for attending.
If you enjoyed this webinar, visit savantwealth.com/guides and download our complimentary guidebooks, checklists, and other useful financial resources.